Celsius stock is crashing hard. The stock is down over 50% in less than 2 months, and the stock is in a constant negative news cycle. I mean, just look at this chart. This is bad. Like, really, really bad. So bad, it even wipes off the smile off the face of John Feedley. So, is this stock a buy? Let's find out. Welcome back to Grown Quality. Now, we will start with looking at the fundamentals. Then we will look and see what the bad news actually is. Look at the issues the stock is facing, the company is facing. And then we will look at the facts in the numbers from their quarterly reports or maybe their growth. See if we can get some statistics. Now, then we will see, is this actually a problem? Does this company actually have problems, or is this just fear setting into the markets? We'll let you know at the end and give you my conclusion, but for now, let's start with a basic understanding of the company, what it does, so we are all on the same level. Okay, so Celsius makes energy drinks. They are competitors of Red Bull and Monster, for example, but what sets out Celsius is that they use healthy, natural ingredients. They are more health-focused, which is their unique selling point. Celsius is the number 3 energy drink in the United States by market share. They have 4 core product lines, and they want to add 6 countries, all which they distribute to in 2024. They're also 20 years in operations. However, the stock and the sales of Celsius really boomed during 2020 and after. Now, the attractiveness of Celsius stock lies in the numbers, in the growth this stock or this company is having. Revenue growth for year-over-year during Q1 was 37%, with net income growing 89% and diluted EPS growing 108%. Now, these are just the numbers, and we'll look at how that compares historically in just a second, but this is important to know. Also, in terms of that sales growth, we can see that Celsius is the number 3 energy drink brand in the US during Q1 2024. They had an 11.4% market share and a year-over-year change in dollar value of $240.5 million. And this compares to a slight shrinkage of Monster and a growth of Red Bull, but way lower than that of Celsius. Now, if we look at the Celsius revenue numbers, the growth of it on a yearly basis, we can see that in the last 2 years, they grew at 105% per year. Over the past 5 years by 90% per year, and over the last 10 years by 62% per year. So these are really good and strong growth numbers. That's what makes this stock so attractive. But first, before we go into the numbers and go too deep on them and try to pick out any judgment from it, let's first start a bit at fundamentals and the issues this stock is facing. Because Celsius market share is under pressure as customers trade down. Now, this is from one of the recent price cuts that we saw in a slide in the beginning. One of the many price cuts, I should add. Now, an analyst at TD Cowen lowers their sales estimates and price target for the energy drink maker, citing both slowing sales growth and market share erosion. Yeah, market share erosion is something new here. And this is really not something we want to see. But maybe it's just a fluctuation. Let's continue. Now, the article continues with saying that lower income consumers are trading down from energy drink to carbonated soft drinks. But if we look at the end part, it basically says that competitors such as Monster and Red Bull are responding to the slowdown with increased promotional activities, further hurting Celsius market share. Now, Red Bull and Monster obviously have way larger marketing budgets than Celsius has. So this is understandable. If they are ramping up their promotions, Celsius can't be aggressive on this as the other two bigger companies can be. So that will hurt Celsius, yes. Now, another fear that's been stated in another article is that if we look at the lower part, the bulls retreated amid concerns about the slowing sales growth, market share losses, and inventory reduction at its distribution partner PepsiCo. However, Celsius stock can still bounce back and generate 10-bagger gain or more over the long term if it successfully scales up its business. Now, becoming a 10-bagger in this industry will be a bit difficult as they have a market cap already over 10 billion. Monster is currently at a 50 billion, slightly above it market cap. So becoming a 10-bagger will be difficult. However, never say never, of course. But that's a bit optimistic. Now, we do know that PepsiCo is lowering its inventories, but more on that later. Now, part of what was responsible for the very impressive growth of Celsius is that distribution. Because Celsius has a distribution deal with PepsiCo, and well, PepsiCo, of course, has a very extensive distribution channel. That's part of PepsiCo's and Coca-Cola's mode. Celsius can make use of this. As part of the deal, this means that PepsiCo made a strategic investment in Celsius. This can be seen because as part of the transaction, PepsiCo will make a net cash investment of $550 million to Celsius in exchange for convertible preferred stock. Shares underlying the transaction were priced at $75 per share, or approximately 7.33 million shares, which equates to an estimated 8.5 ownership in Celsius on an as-converted basis. The preferred shares are entitled to a 5% annual dividend. Now, that $75 is pre-split because last year Celsius did a 3-for-1 stock split. So on an adjustment basis, this means for about $25. Now, having that 5% preferred dividend might be a bit of a high price for it. However, making use of the PepsiCo distribution channels, well, that of course is, well, quite valuable. I mean, you get a big jump in sales, potentially. So after the Q1 2024 earnings report, the stock, well, started selling off quite badly initially. And there were a few reasons for it. So one of them, for example, as we can see from this slide in the investor deck from that earnings presentation, was that changes in days on hand inventory by the largest customer adversely affected the year-over-year Q1 revenue growth. Now, the largest customer is PepsiCo. PepsiCo buys Celsius from Celsius and then distributes it themselves. But another part that was very important here was that the gross margins of 51.2% were up, well, 740 basis points year over year. But this was driven by reduced freight and materials. Now, a reduction in freight cost is very positive. But how sustainable is it? That's the question here, because freight costs fluctuate. This is also what Celsius said in the earnings call, so that can drive up costs again in the future, which will bring down margins. So that's a bit of a constant factor of fluctuations, and in this quarter it was really well. But this 51.2% gross margin, I don't know, it might be on the high side, it might be sustainable, it might be a good average, but it's 740 basis points growth in 1 year. That's a bit extreme. That's a bit much. Now, if we look at the performance of the SPY, the ETF tracking the S&P 500, we can see that this is up 32% over the past year. This compares to Celsius Holdings 9%, so Celsius Holding on a 1-year basis is trailing the S&P 500 quite badly. However, if we look at it on a 5-year basis, that switches the roles around, and quite substantially, I might add. Because over the past 5 years, the SPY, or S&P 500, is up a bit over 80%, while Celsius stock is up 2,900%. Yeah, that's a bit of a difference. That's, yeah, a bit of a difference. Okay, so then we might ask, what has caused this big difference in performance? Because the 5-year performance from Celsius, well, it's not even comparative to the S&P 500. It just blows it completely out of the water. Well, if we look here, we can see that the sales from Celsius are just, well, they increased an incredible amount. If we look at Q1 2020, they were well under $50 million per quarter. Well, if we look at Q1 2024, they were a bit over 350 million. In Q3 2023, they even got close to 400 million. So that sales growth is, of course, what's going to drive the stock upwards. It's going to give a lot of momentum. That's only logical. However, when we look at it on a year-over-year basis from the latest earnings release, then the numbers or the revenue growth starts to look a bit different. Because there was revenue growth of about 35%. And well, that's a bit different than 100% year-over-year growth. And of course, 100% year-over-year growth, that's simply unsustainable. You you will not sustain it, that, and especially not in this market. However, they have been growing at those rates for the last 2-3 years, but that growth's gonna come down. And in Q1 2024, it was slightly over 30%. I believe it was around 33%. Now, we saw the cost of revenues not go up as much as the revenues, so that's very positive, of course, because that will increase gross margins by quite a healthy amount. Now, sales and administrative expenses, they were up a bit as well, but not as much as the revenues were up. So those income numbers do give a very healthy image of this company. It's growing at a really good pace still, but just simply not that over 100% that we saw in the past years. That's not an issue. Over 30% revenue growth year over year, that's still very, very impressive. It's just lower than 100%. Now, if we look at the net income, as you already said, this was up 89% year over year. So the net income, once again, far outpacing the growth from revenues. So that's earnings leverage, and that's very positive to see. After the net income, we still have to take out the preferred dividend that goes to PepsiCo, and that will be about $6.8 million. And we can see net income attributable to common stockholders is $64,846,000. So that's, well, almost double from a year ago. So that's very good. I mean, that's really, really impressive. And then we see the earnings per share on a diluted basis, 27 cents compares to 30 cents last year. So that's, of course, a very big difference. However, if we look at some of the key metrics, the statistics from Celsius Holdings, we can see that they have a market cap as of July 22nd of 11.22 billion, a trailing 12-month PE of, well, 52.9, and a forward PE of 48. You have a PEG ratio 5-year expected of 1.66 and a price to sales ratio of 8.08. Now that's a high PE. That's something we can already see. A 48 forward PE, that is really high. However, when you have big growth, you're gonna pay up for that. So if that's excessive, that's up to your standards. I think it is on the high side, especially given the uncertainties that we have already stated before. Now we see a price to sales of 8. Same issue here. It's on the higher end, maybe, given the uncertainties we are seeing with shrinking market share, consumers trading down, and just overall bit of pressure on the consumer and a bit of uncertainty on that side. I think the stock is quite highly valued given those circumstances. But let's just continue. Because, well, we see slightly over 30% revenue growth. This is mainly from the US, because on international markets, they are just not as big yet. Now, they are planning on expanding more internationally. And the sales in the UK, for example, began in April of 2024. And initial channels include fitness and gym. They started in Ireland, also April 2024, with initial channels including fitness and gym. They expect to go into Australia in the fourth quarter of 2024, New Zealand, fourth quarter 2024, and France, fourth quarter 2024. Now, in those 3 remaining markets, Australia, New Zealand, and France, they will probably also start by, well, introducing their products in health centers, gyms, in order to keep that health-centric brand going. This is what's really important for Celsius, how they want to be seen. And that's also why they took this approach in the UK and in Ireland, starting off with fitnesses and gyms in order to, well, like I said, keep that health-centered. Now, we know that people are very enthusiastic about the growth that Celsius is having, about the revenue growth, earnings growth. However, there are also risks to this business. And one of them is concentration risk. Because if we look, we can see that PepsiCo makes up for, well, 59% of the revenues for Celsius, and Costco makes up 10% from their revenues. And this is where the issue slightly lies that has been fueling this downward trend of Celsius holdings. But once again, more on that later, because let's just go over all the issues we are having so that we can, well, summarize them at the end and get a clear picture, and I will give you my thoughts on them all. Because there is one more risk, which just isn't as, well, I think it's a bit hidden, but it's quite negative. And that is that they have identified a material weakness as of December 31st, 2023, in their internal control over financial reporting. And this was not fully remediated as of March 31st, 2024. Now, this comes out of their Q1 earnings report, and it's a bit hidden away. It's a bit in the later pages with all of the info that nobody really wants to read. But having issues with internal controls over, well, reporting your financial results, I mean, it's something that analysts see, and they are gonna make the big swings in this stock because they need to hold it in order for the company or the stock to stay stable. And those things don't really help with that. So then I have one final issue going here, and this somewhat comes back to the inventory and market share problems I have already stated in the beginning of the video, because this is a bit of the transcript from the Q1 2024 earnings call. And basically, the company cuts asked, I just wanted to come back to the inventory for a minute, and I think you've been very clear not to expect a snapback or an inventory restocking, but should we expect any more destocking? I know you said the inventory levels feel about right, but how long could it go, or how low could it go? Is that something we should watch for or watch out for? So what the analyst is referring to here is the destocking of inventory from PepsiCo. And this was quite well explained in an analyst call later than this Q1 earnings call. And basically what Celsius said is that PepsiCo just bought a bunch of Celsius drinks in order to, well, that's how I interpreted it, in order to never be short on supply, so that they can just push out the inventory and just see how well it gets received. After an initial phase, they can then say, okay, this is how much inventory we need, and we can right size that inventory. And that is what is happening. So that's not something really negative nor positive. It's just something that happens, but is good and is a bit natural, but might give a bad impression, especially given the fact that there has been said that they are shrinking market share. The product isn't selling as it used to based on data that is, well, available to those analysts. I mean, I can kind of imagine it. However, the answer here is more telling, and that's what I wanted to highlight. Because John Feely said, yes, I mean, I can't control that, or we can't control that. I think it's sales are flowing, sales are strong at the register, so it seems to be like the balancing has been finalized. But who knows what next week or the week after happens. But I think, right now, it seems somewhat stable as we ended the ending March. Now, this is somewhat of an issue here because this answer implies that at the current sell-through, the balancing in inventories is done. But we know the current sell-through at this point in time isn't the sell-through it is right now, because there is data from Nielsen, they track the registers, that says that Celsius is slowing down in sales. So if that truly is the case, then that might mean that there is more rebalancing in inventories from a PepsiCo coming. And that's what the analysts are fearful here. However, there are also positives that can be said, because this is the expected growth of the energy drink sector in billions going up to 2029. Now, this data is coming from Statista, something I find highly trustworthy and reliable. And we can also see the mix between offline and online sales. Offline sales will shrink a bit as online sales will grow. Same study, same source, still Statista. So let me then give you my, because we see some very positive things about Celsius, mainly the very very impressive growth this stock is having. But we also see a few negatives, like the slowdown in sales or expected slowdown in sales, the rebalancing, the internal controls. There are a few things here and there that are, well, justifiably weighing on the stock. Now, I also believe that Celsius is valued quite richly for the pressure the company is under. Because having those issues with sell through, with market share, with PepsiCo rebalancing their inventories, a 50 PE with slowing down sales growth or revenue growth, I mean, that's quite rich. They are trading for about a slightly over 2% free cash flow yield. So that is good. That's around market average. So that means they have a bit of, well, fair value more so in that free cash flow yield. However, once again, that PE, that is still, the forward PE of 48 is still quite high. So I think having the stock under $50 is good. It might be painful for people who bought the stock in the last half year, but I think that's more geared towards fair value. I think it might go even down a bit lower, but giving it a price target, that's a bit difficult. I think 40 will be very low, but 45 might be more where it bottoms out or where I can see it bottoming out. However, the vicious downtrend it is in with losing over 50% in the last 2 months, I mean, it's just selling going on everywhere. So if this stock would continue to, well, drop through $40, I wouldn't be that surprised. However, at that point, it might become a really interesting buy. Now, having said that, I want to thank you for watching. Please remember to like and subscribe to my video if you have enjoyed it. And, well, I hope to see you in my next video.